Belrise Industries has actually posted a strong second quarter as well. Now, to add to that, if you're talking about the way auto sales numbers have panned out so far, what you're expecting, if you have to put all of this into context before we speak to the management, what would you have to say? Because the stock is down 1.5% today.
Well, it is a performance, a strong performance that they reported in quarter two, roughly 19% growth in EBITDA, but profits was up 81%, led by a lower finance cost and higher other income. So that did boost the quarter two performance. But post that, we have seen the company being a key beneficiary of the two-wheeler growth because of the GST rate cuts. 81% revenue in quarter two came from the two-wheeler space. So one key comment from the management on where do they expect the share to go? Because the last time we spoke to them, they were positive on the four-wheeler space and the revenue growth for them. So that'll be the first question to the company. The second is also in terms of, how is the split between motorcycle and scooters? Because we have seen the latter segment actually grow much faster. And the third key one, in terms of, defense, they have mentioned a couple of key order wins in this particular quarter, continuing momentum with the Israeli defense deal as well. So these will be the three key things I'll be watching out for from this conversation.
And you've set it up well, Puneet. Thanks so much for that. We're joined this morning by Swastid Badve, who is the management of Belrise Industries. Swastid, thanks so much for taking the time. And let me get this out of the way, because I think everyone's focused on the strong set of numbers that you posted, the PAT growth, the EBITDA growth of 19%. But there was a little bit of a lower operating cash flow during the quarter. We're just wondering whether there was an impact of the rollout of GST 2.0, inventories playing a bit of a spoil sport there?
Yeah, I think you answered the question perfectly. I think the fact that there was a bit of a GST rollout happening in this quarter meant that until the 22nd of September, a lot of consumers didn't go ahead and buy two-wheelers, which meant that until the end of September, there was a bit of stockpiling across multiple different OEMs, which also led to a similar situation at our end. And due to that, inventories were a little higher. We also have multiple plants coming in this fiscal year. So we've already ramped up two facilities, one in Chennai and one in Pune. And we have two more facilities coming up, another one in Chennai and another one in Bhiwadi. So around four facilities coming in altogether, which also led to a bit of decrease in cash flow. But all in all, we expect these effects to be transitory, and hence we expect to have a strong cash flow position by the end of the year.
Got it. Okay. And I believe Sumedh Badve is also with us. Sumedh, thanks much for joining in. And amongst the companies, guys, kudos in some sense, amongst the companies that got listed recently, right, in calendar year 25, you are amongst those which have done well too. So in some sense, investor wealth is created. And I think the belief is that you are executing a pivot to high margin, high CPV content, which gives you stable revenue growth, but at higher margins and therefore higher EBITDA and higher PAT growth in some sense. Would that be a fair assessment?
See, fundamentally, every company wants to, for any company to do well, you want to increase revenues, increase EBITDA, increase ROCE, increase growth, right? Fundamentally, these are the four main primary areas that you want to target. We're also pursuing the same strategy. I think the idea is to see how we can increase content per vehicle, and as has been previously stated as well, move towards the four-wheeler segment where there is an opportunity for us to grow. We've established a certain level of market leadership in the two-wheeler space. We believe that can further be increased. We're obviously not losing sight of the two-wheeler space. That is our bread and butter, and we want to concentrate on that as well. I think the four-wheeler space opens up another opportunity for us to grow further. And obviously, in terms of moving more towards the proprietary and premium engineering segment, that is an opportunity we're trying to capitalize on, and we're putting our resources also in that direction, yes.
Okay, and Swastid, in conjunction with what Alex asked you and what Sumedh just mentioned, if there is a fair degree of ramp up that is happening and working capital needs needed, would it test execution, or do you believe you are well capitalized by having capital as well as cash flows to be able to meet all of these things easily? I think Alex briefly asked you about it, but I didn't quite get the answer that I was looking for, so I'm asking it to you again.
Yeah, so we already have had, more than 20 plants set up in say the past 2 decades since the company was launched. So I think the new plants that are coming in, of course, there will be a ramp-up period required over there where we'll, of course, have to go through the grind of taking a product right from inception to mass production. But we feel that we have the bandwidth, the resources, and the wherewithal to kind of, execute these ramp-ups consistently. Of course, during the ramp-up period, we'll not have optimal EBITDA margin, so there'll be that offset technically. But as my brother also mentioned, four-wheeler and commercial vehicle is a segment that we're targeting. If you look at our growth, we've grown more than 50% as compared to the first half of 26, as compared to the first half of 25 in the four-wheeler and commercial vehicle space. So four-wheeler and commercial vehicles have slightly better margins than the two-wheeler space. So all in all, that's why we're guiding for a stable EBITDA margin going forward. And we feel that we will have all the resources required to execute this ramp up over the medium term.
Right. Hi, Swastid. Hi, Sumedh. This is Hiral on this side. Interesting points that you made when it comes to ramp up, when it comes to diversification. If you have to look at the revenue mix change because you're ramping up your exposure when it comes to four-wheelers and you're looking at defense and solar as well over the next 2 to 3 years, how will that revenue mix shift happen? And secondly, how will the contribution when it comes to content per vehicle grow from here on over the next 2 to 3 years?
Yeah, so I can take a part of the question. Maybe Sumedh can add more on the defense part of it. I think defense and renewables is an important part of our strategy going forward. So if you look at the defense bit, we've already started working with 3 armored vehicle defense OEMs. So we're already supplying to 2 Indian defense OEMs and also exporting to a large Israeli OEM. So with the Israeli OEM, we're not only exporting to them in Israel, but we'll also look to export to them to other parts of the globe. And this is all across the core capability of what Belrise does. So we specialize in fabrication, in machining, in plating, painting, and assembly. So we're using all of our key processes, key strategies to kind of move into these new segments. So we're extremely bullish on the defense and aerospace segment going forward. We feel that India is a best cost country when it comes to aerospace and defense, and hence we like to take advantage of that to really grow this segment. Similarly for renewables, I think the tailwinds are very strong in the segment, and we're working a lot on the structures part of renewables, where we're making the metallic structures on which the solar panels and solar trackers sit. And we're doing that not only in India, but also exporting that to North America and Europe. So that in itself is also a large opportunity. I think we'll not be able to get a sense of what the mix will be in the longer term, but we do expect non-auto growth to be robust going forward, and hence for that to reap dividends for us in the future.
Okay, and Sumedh, would you want to add in terms of the content per vehicle as well? What is that going to look like? Because the new proprietary high margin products is something that will probably drive this aspect. So what does that look like? Because you have your suspension systems, you have your cross car beams, your steering columns, all of that comes into play.
Absolutely. So I'll add a little bit on the content per vehicle as well as on the renewables and defense side. With respect to content per vehicle, where the 17,500 is what it is in the two-wheeler space, and that's how, and we're getting there with the addition of the likes of filtering systems, with suspension systems, with steering columns, which are another premium product, engineered products really. Coming back to the previous points I was speaking about with respect to renewables and defense and manufacturing really in India, there is the volatility and vulnerability in the world with respect to supply chains is increasing globally. There is obviously a need towards Atmanirbhar Bharat with manufacturing in India, and given that, I think our not only automotive but us specifically, we're very well poised to be able to capitalize on this positive shift with respect to very well structured supply chains, global supply chains, the manufacturing prowess, and the ability to deliver manufacturing excellence at scale. And given all of that, I think historically what the challenge has been is, and why it has not been done to manufacture in India at that volumes has been cost and quality. I think that's where we can best contribute with respect to both renewables as well as in defense, and that's what we're targeting towards. Yeah.
Swastid or Sumedh, either one of you can answer this. I'm just wondering, at FY25 revenue of 8,300 odd crore rupees, and based on the trajectory that you've shown, based on the tailwinds that you currently are witnessing in the automotive business and the diversification out, would you have internally revised your projections for top line growth I'm not just talking about FY26, but heading into FY27, 28 higher? And would you be comfortable sharing what that trajectory will be?
No revised guidance from our side. In the last 3 earnings calls, we have maintained our guidance of doing a mid-teens type of growth with stable EBITDA margins. We still expect to continue doing that. And I think what will be very important from a company perspective is to make sure that there's sustainable growth. We don't want volatile growth where we, grow 1 year and then, don't grow as much the next year. Our perspective is to keep building sustainably and gradually and to keep delivering on what we've committed to our investors.
I must congratulate you on on a lovely answer. I have gotten some answer through that, but I think the smiles on your faces answer more than what you have said. Hiral's got a question.
Yeah. Okay, my question to you is mainly when it comes to your EV strategy and the powertrain agnostic products. Now, what percentage of your portfolio is genuinely powertrain agnostic part one, and what is that growth pipeline looking like when you talk about this EV specific components business from here on, and the acquisition synergy that you're seeing with H1 India and Mac Filters?
Right. So I can answer the powertrain part, and then maybe Sumedh can take the H1 and Mac filters. So our powertrain agnostic revenue as a percentage of our manufacturing revenue is around 73 to 74%. And we think that is applicable across, as you mentioned very clearly, it's applicable across both ICE and EV. So the chassis systems that we make, or the suspension parts we make, or the plastic parts we make are going to be used across both EV, ICE, and hybrid. So that will remain and continue to grow going forward. While the remaining part, the remaining 27% of our revenue, which is not powertrain agnostic, is the exhaust system revenue. However, a large majority of that is towards motorcycles. And as we know, motorcycles have been slower to electrify as compared to scooters. Hence, we don't expect a lot of cannibalization in the motorcycle exhaust space also going forward. We expect the whole two-wheeler pie to continue keep on growing. And of course, motorcycles to also grow within that.
And the second part of the question that Hiral asked, Sumedh, you want to add to that?
Yeah, I'll take that. So fundamentally, with respect to acquisitions, the key challenge and the opportunity really is the proper integration of the new company that is added with the parent, and making sure there is streamlined growth as a result of a combined offering. Happy to share that is coming along really well. On the H1 note, the capabilities in high tensile strength manufacturing have actually allowed us to already enter the medium and heavy commercial vehicle space with certain new products that are high tensile. So that is, these are already certain early wins that we're seeing because of that. And we're seeing very positive insights from the industry, which and talk around the high tensile strength materials, especially given the EV component that is coming about. As you know, with electric vehicles, vehicle lightweighting becomes a critical part of the vehicle evolution, and we are keen to play a key role in this vehicle lightweighting through our high tensile strength manufacturing capabilities.
Sumedh, thanks so much for taking the time. Swastid, thanks so much for taking the time and speaking to us this morning. Wish you all the best for the rest of the year. All right.